Welcome in, folks. Got a three-piece for you here today. 3 videos up for me to react to. Everybody's favorite bull, Tom Lee, went on CNBC 6 hours ago, spoke about his views on the market, where we're headed here. Want to react to that, kind of give my opinions and perspectives. Next one up here, large cap value companies will be the best performing area for the next 10 years. Oh, this should be a very, very interesting one to react to there. And I'll let you know my opinion if I think that's accurate or not. And then the last video I want to react to, short sellers risk extinction as equity rally rolls on. Okay, that should be a very interesting one to react to here today, folks. Okay, appreciate y'all joining me as always. All I ask in return, take 3 seconds out of your day, hit that like button, and make sure you're subscribed to the channel. That's it, folks. Did you know not only like less than 10% of people click a like on a YouTube video, man? Come on. Like, we got to at least get up to like 20% or something like that. Like, I think we can climb a little higher than less than 10%. All right, guys, let's get into this.
We're not going to bury the lead on this. Let's get to Tom Lee. Fund strat. He's pretty amazing guy that we try to visit with as much as we can. He's on kind of a roll. He is managing partner and head of research at Fund Strat Global Advisors, also a CNBC contributor. And once again, you're doing exactly what I tell you not to do, Tom, and that is giving a price target and a time frame. Never do both. Never do one or the other, but you're doing it again. So 5,500 on the S&P by the end of June. It's hard not to talk about that immediately. Based on, Tom, lower inflation.
That's right. I think there's a fundamental case, Joe, which is inflation is coming in softer than expected, and I think the job market is it's cooling but not weakening dramatically, and I think that's a good situation for equities. And I think that the sell-off in April actually hasn't really been fully recovered, and that's why we expected a rebound in May, but I think that carries over into June, and there's still $6 trillion in cash on the sidelines, and margin debt's still way below where it was in October 2021. So we know investors really aren't that long yet. So I think that comes together this month with a pretty surprisingly robust move higher.
It is.
So to push back against his point on margin debt, right? Margin debt being lower than it was back in 2021. Well, hold on, sir. Hold on just one flip and flapjack moment. 2 things. First, very important. Interest rates are substantially higher today if you want to take out margin debt than where they were in 2021. You could take out margin debt. If you had a good chunk of money, you could get margin debt at 3%, 4%, right? Try getting margin debt at 3-4% now. It's not happening. You're looking at 7, 8, 9, 10% on margin debt. So naturally, there's going to be less margin debt if interest rates are considerably higher. Okay. Secondly, that was a whole different market. We know 2021 was a FOMO, crazy, out of control market. You don't want to compare back to that time frame and say, well, at least we're not as crazy as that time, because that was the craziest time, probably in the market other than the tech bubble. Like, that was just pure pandemonium in the market.
A little bit longer than that crazy call you made. It was based on a week, Tom. I remember, and it worked out for you. You were right. So now at least you're doing it in terms of a month. In the past, when you have made these calls, it's been about inflation, hasn't it? And that's where it is again. What are you seeing in terms of components that make you confident that those were outliers that we saw a couple months ago, where it looked like it was inflation was coming back?
The April inflation data, both CPI and PCE, kind of revealed that the 2 things that the Fed's been waiting to cool are starting to cool. One is shelter inflation. It's decelerating, even though it's still higher than the Fed would like. And then I think there's some evidence that auto insurance, which has been, rising over 22%, is beginning to sort of normalize. And I think sometime before the second half, auto insurance is no longer going to be contributing to inflation. So that's the dynamic we think that's at play in this upcoming May CPI report. That comes out May 12th.
I disagree. In terms of hoping auto insurance is going to hit the inflation numbers, you got to wait till next year. Next year, they're going to continue to hit this entire year.
The other lead I didn't want to bury, and this is another crazy call, Tom. 150,000 on Bitcoin by the end of the year? It's already June.
Yes, we're still constructive on Bitcoin. There's the tailwinds that are associated with the halving that just took place. We also know because of the Bitcoin ETF, and there have been tremendous inflows, but institutional sort of adoption and infrastructure being built around Bitcoin is only beginning. And that makes, crypto, especially Bitcoin, a bona fide asset class. And I think that sort of widening ownership is going to be propelling Bitcoin to 150,000. And again, maybe surprising or not surprising, Bitcoin still follows math. More than 87% of the move in Bitcoin still follows just the number of wallets and the activity per wallet, and both are moving higher.
Tom, I would think that a lot of your calls are based on the Fed cutting too. Bitcoin's not going to 150 if the Fed doesn't cut. So you must think that the Fed is going to be able to cut. Is that because of inflation? Is it because the economy slows? Fundamentally, what do you think has to happen for all these bullish things in both stocks and crypto to happen with the Fed?
I think it is important for the Fed to not have hikes on the table. So I think that's the most important for investors, is the Fed is no longer in a rate hiking cycle. But if the Fed makes even just one cut this year, I think it's really supportive of equities, because it really shows the Fed is trying to sort of nurture the business cycle, and it's a good environment for stocks. I don't think one cut or three cuts makes that much difference for stocks, but again, you're exactly right. It all depends on inflation, really the edge coming off enough for the Fed to say we're comfortable cutting this year.
But not necessarily. We could have Goldilocks. We could have inflation come down and the economy continue to do okay.
Yeah, that's right. I mean, I think the companies' earnings have actually really spoken to how in a 5% pretty restrictive rate environment, earnings have been really robust. I know consumers, there are some trouble signs out there, but consumer leverage is still quite low. And of course, if the Fed does begin to cut, there's a lot of levers that will boost both consumer wealth and company demand. So I think there's still positive catalysts that are associated with a Fed cut eventually.
All right, Tom Lee, not much more that needs to be said. We'll be able to, that's just way too specific. But
So a few things to add here. Okay, first off, obviously Tom Lee's always going to look very intelligent in a bull market, right? He is the quintessential kind of perma bull out there. And when we get into bear markets, he looks like the worst guy in the world, right? Everybody makes fun of him and all those sorts of things. We know that happens, right? Go back to 2022. If you were watching my channel back in 2022 when we do these reactions, I mean, they were just beating up on Tom Lee every single time he would go on in 2022. What's going on, Tom? Why are your calls not coming in? All these sorts of things, right? He was, I think he was definitely one of the people that was laughed at the most in the Wall Street community in 2022, right? But when the market's doing well, he's obviously very, very loved out there and very much looks like a genius in a bullish market, right? Now, I think there's risk out there, right? I think there's risk when it comes to the economy. I really do. And, when you think about things like insurance going up substantially, let's say your car insurance goes up 22%, right? It's not like that just hits you one time. It hits you over a period of time, right? It hits you the next month and the next month and the next month. It's not like it goes up 22% and then, it's not like it's there anymore. It still continues to hit you, right? So, I think there's still a significant amount of risk out there. I think the Fed does likely lower at some point. I don't know if it's September or if it's more toward like November, December, but they likely start lowering probably this year, but might be one cut. And once again, that's not going to make any significant difference, which once again goes into what I've been saying for a while now at this point in time. Like, interest rates are going to be high for the year, right? And so that's just what you have to deal with. And then the weighing on the economy. Next one up here. Let's talk about what stocks might do very well or not very well over the next 10 years.
Off trading in June. Let's talk markets now with Savita Subramanian, head of U.S. equity and quantitative strategy at BofA Securities. Was it a month ago? When did we see you last?
I can't remember. Time means nothing these days.
It's weird. It's like Einstein was right. It's like time dilation. You've been feeling pretty positive.
I have, yeah.
And does the divergence from the Dow, 1,500 points, whatever it is, that from the highs, has that got you concerned, or you expect the Dow to catch up with the NASDAQ?
Right. The Dow is supposed to be this sort of wonderful canary in the coal mine of industrial activity. I mean, I think the indices themselves are a little bit flawed right now because, if you look at the S&P 500, it's, 7 stocks. If you look at the Dow, it's pretty, top heavy. So I almost feel like when you peel back the onion and you look at the underlying stock market, what makes me feel better is that earnings are coming in positive for a broader array of companies in the S&P. It's not just the Magnificent Seven that's doing all of the work for the index. So I think that's bullish. What makes me a little bit more worried at this point is I feel like the idea of being in a bull market is not.
I don't know. Is she accurate on that? Let me pull up. I got the equal weight S&P 500 on here. I want to see if she's right. That's RSP, if I recall, right? So equal weight S&P. So let's pull up a year to date. I mean, it's not great. 4%. If I recall, it's still getting significantly outperformed by the regular S&P 500, is it not? Right? Let's see. Yeah, it's not even close. It's not even close. So what she just said there, it's not really accurate, to be honest. Equal weight still is really performing pretty dang bad. And same thing with the Russell, right? The Russell Wilson's doing a whole lot of nothing. I mean, the Russell Wilson, come on, man. Come on. 1% this entire year? What? And so that's where it's just like, anybody that's claiming like the Russell or the equal weight and the other stocks outside the big ones are starting to come together, they're not really. They still haven't. It doesn't mean they're not going to come together, but as of right now, the fact is the whole market's still being carried by the biggest of the big dogs out there, and everything else is really floundering.
It's not necessarily new. We're not faced with a bunch of bears anymore. People agree with us more than disagree with us. So it feels great to go into a meeting and be agreed with, but it doesn't feel like we're fighting that wall of worry anymore.
I mean, I don't know.
True. She is 100% accurate on that, right? Even Mr. Mike Wilson, I think, moved off the bearish side, was that 2 weeks ago or so, right? The biggest bear out there. I mean, he was one of the last long-standing ones, which, when you start to feel like you can't fight any more bears, you start feeling a little toppy on the market, right? Because it feels like, man, there's just no one else to kind of get over to our side over here.
Count on multiple expansion. It's not cheap, is it? What do you have as your multiple on the S&P for next year, based on next year?
So based on where we are now, I think the trailing PE and the forward PE are kind of reasonable. But look, I think
it 21?
It's 21, yeah. And it sounds very high, but I think when you look at what's in the index, it's very different from prior cycles. It's a lot of asset light, innovation, high margin industries. AI is part of it, but I think, maybe that's the area where there's a little bit more hype than reality. But I do think that productivity and efficiency are really bullish stories. And we've been talking about that for a while. I feel like a broken record. But I think that's what you really want to see corporations do, is generate earnings from true replicable processes rather than just borrowing money for free. So that's what makes me bullish, is we're off the Fed, kind of stimulus machine, and we're in a more normal, rational market environment.
You need earnings to lead the way then. So what type of gains, S&P percentage gains year over year?
This year?
Yeah.
Well, I mean, our target is 5,400, which isn't too far away from where we are today.
No, that wouldn't give you much. It
doesn't give you a whole lot.
How about next year?
Well, next year I think will be, I think it'll be a solid year, but I think price returns are not going to be as exciting. So where we're going to get more of our bang for our buck is from dividends. And dividends are kind of a forgotten story because we've had, buybacks being the way the companies are returning capital. I think over the next 10 years, the best performing area of the the overall U.S. landscape is going to be large cap value companies.
Okay, before she goes in there, I think there was an important point she makes in regards to, feeling like there's not as much of a great return profile kind of moving forward, right? Let me show you something very important here. Alrighty, folks, here we go. Andre posted this in the private stock group Discord chat under the breaking news category. He posted this yesterday, and I want to show you, because this is very important to understand, right? The best returns you're always going to get in the stock market in terms of the overall indexes is after you've gone through a crash or some sort of bad market, right? For instance, 1990, look at that. Market goes down. It actually has a rare red year, right? We know red years in regards to the market, they don't come very often, right? So after a red year like that, you had a massive bounce back year, 30% return, right? You had the whole tech bubble popping there that was vicious for the market to go through. And then look what happened in 03, a 28% return, right? And followed up by another double-digit return in 04. Great financial crisis hits. Boom, stocks get nailed. But then look at how the market recovers over the next couple of years. Phenomenal returns the next couple of years coming out of that, right? And then as far as return profile over the coming years, this was, getting the employment cycle back in a good place again, right? And so, then look at right here, 2018, bad year, red year for the market. And look at that bounce back year, right? And then 2022, bad year for the market. And then look at that bounce back year there, right, in 2023. So that's an important thing to understand. It's not that you can't get returns, after you've had a good year or a couple years in the market. It's just the returns are more limited, right? The big money is made. The big, huge money is made after a crash, right? That's when it's really, really made out there. And so just a little food for thought in regards to that. And that's why it's so important to be buying the dip when you're going through those crashes in the market or those corrections, because they don't come very often. They don't come very often, just factually, right? They don't come very often. And so when you get those opportunities, you've got to take advantage of those opportunities, right? I was buying a lot of stocks heavily in 2022. It was a phenomenal opportunity, right? Those don't come very often. So when you get that opportunity, you better pounce, because it could be years before you get another opportunity, right? 2022 was a bad year for the market. How long is it before we get another bad year in the market? I don't know. I mean, if we finally get an unemployment recession, maybe it could be in 2025, right? But does that hit? What if it doesn't hit, right? What if employment market stays strong? It stays under 4.5% unemployment and real wages get in a good place? Then 2025 would be a good year, probably leading into 2026. And so it's like, well, then maybe 2027 is a down year. Maybe then the unemployment cycle hits, right? And we finally have some red years. So that's the problem. Then you're waiting for a long time before you get the next one.
Performing area of the overall U.S. landscape is going to be large cap value companies. Right now, if you buy the large...
How many times did we even get... Look at that. That's insane. Only one time in the past 40 years did we ever get more than one red year in a row. Only one time that ever occurred, right? And that was the popping of the tech bubble. Outside of that, none of those other scenarios did we ever get back-to-back red years. What? That's wild. And that's in a 40-year span. It's not like it's over just like a 5-year span. It's like, they're just cherry-picking data. This is over the last 40 years. It's longer than I've been on this earth. Are you kidding me? Crazy.
Value benchmark. You're buying one of the most hated areas of the equity spectrum. I think there's more bullishness on small caps right now than large value. When you think about large cap value, these are companies like energy and financials that have been starved of capital for the last 10 to 15 years. They are now trained to survive in a high rate environment because they haven't been given any money. And these are companies that can rework themselves based on all these exciting new tools like AI. Think about large cap value companies. They're labor intensive, they're clunky, they're old economy, and now all of a sudden they have this potential to become more streamlined and labor light.
So when she's talking about large cap value companies, she should be likely talking about companies like IBM, companies like Intel, like some of those old big dog companies, maybe even an Oracle, right? Some of those guys is likely what she's talking about, because whenever you talk about large cap value, that's really who you're thinking of, right? Maybe we could say Apple now at this point in time, because Apple's not really a growth company necessarily anymore. So maybe they get put into that large cap value. But what you wouldn't think of is the more growthy type companies, right? So that's a big statement. I wish she clarified more of the specific stocks she was thinking of, right?
Of the dividend stocks changed if tax law changed to raise the tax rates for dividends?
You know, it's such a good question because we've looked at tax permutations and what that actually does to the underlying asset classes. I think what's interesting is that when we saw dividend taxes cut in the mid 2000s, high dividend yielding stocks actually started to underperform. So they do the opposite of what you would expect. And I think the idea is it's not really taxes that matter for dividend yield. It's really where are you going to get your inflation protected income. So you're right. Taxes matter, but I think a lot of these stocks are held in tax managed accounts. Taxes aren't as important in our quant work as one would imagine. I thought that was one of the biggest surprises when we're studying all these different facets of the market.
So you're happy you're not obsessing about the Fed, but we still need to talk probably about the Fed. We're in a 2% GDP world, and that allows the Fed eventually to cut a couple of times this year? Is that your base case?
I mean, I think that we might be in a higher nominal GDP world.
And they shouldn't cut it all then.
My sense is that there is a very high, reasonable probability that the Fed doesn't cut it all this year. This is what our economists tell us. There's even a, very non-zero probability, I don't know what it is, but it's, higher and higher, that the Fed actually, their next move is a hike. And I don't think that would be terrible for stocks. In fact, I think that would be good for value for some of these areas that are more kind of GDP sensitive. Because think about it, the Fed is going to cut if there's something wrong in the economy. And I think you've brought this point out brilliantly in the past that the Fed basically is only going to cut when things are starting to break. And if things aren't breaking, why wouldn't you want to own it?
I don't know why they say it's not political, it has nothing to do with the election, but they've just had that default stance. That's the fallback.
Because they thought the neutral rate was going to be probably lower than it is.
What gave them that idea that when they're seeing no really sopping up of liquidity or
but I think you hear Neil Kashkari and others saying, look, the neutral rate's going to be higher.
It's going to be higher.
It's not where they were assuming it was. It's going to be higher. So they're going to have to see more before they can actually cut.
Yeah, I think that's right. I mean, I think there are structural areas of inflation risk in the market today. Like, look at employment. I mean, one of the reasons that it's been really hard to get wages, modified or moderating is that we have this very structurally tight labor market. We've got an aging population. We've got early retirees. So I think that the only way to fix that problem is maybe ease up immigration, which is more of a political decision. So I think there are areas of inflation that are hard to argue are going to go right back down to, those kind of benign levels that we got used to in the last decade.
That's a good point. All right, short sellers risk extinction.
Today we're looking at the issues facing short sellers in the industry in today's relentless stock rally, and it is also the big take for Bloomberg. Joining us now is Bloomberg's Denitsa Seikova, who wrote this story, and you really spoke to everyone here, from Jim Chanos to Andrew Left. And are they really all throwing in the towel at this point?
We started looking at the data, and we started looking at the S&P member, and the short interest was down to 2001 lows. We started looking at the number of hedge funds. It's down to 14 constituents, according to one of the indices. So we went to the big names. We went to Jim Chanos. He said it's hard to raise capital. It's kind of impossible to raise capital. And you can imagine if Jim Chanos himself is struggling to find money in short selling, a lot of the smaller players probably find it even more difficult. We went to Andrew Left. He called them a dying breed. We reported recently on Carson Block launching his latest fund, and it's a long-only fund. And that reflects a lot of the industry.
Hey, listen. Here's why. Okay, let's count it up. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. So of the past 15 years, right, 13 of those 15 years have been green, and only one of those last 15 years have been red double digits, right? Some point, we're going to have a really big down year. And potentially, maybe we'll have a freak situation where we have 2 or 3 down years in a row, right? And that's why hedging is very important. You learn hedging, right? That's a subject I teach in my private stock group. I teach you about, growth stocks, value and dividend stocks, value stocks, right? I teach you about all the income statements and balance sheets and cash flows and, how to look at PE ratios versus growth rates. And are you getting ripped off on a stock? Are you getting a great deal, right? But one of the other important subjects I've covered in there over time is I have some pretty extensive videos on hedging, because we will have a major down year here in the future. And I think it's probably in the next, I would say, 3 years if I had to put a time frame on it. I think there's a high probability we have a big down year, and potentially even 2 down years. And guess what's going to happen? All the negativity around the short sellers will go away, and then people will actually be interested in investing into these short seller funds again. Okay, so just you got to understand the times that we're in, right? When things have been really great for a really long time, people say, who cares about trying to figure out hedging? Who cares about investing in these short seller funds, right? There's no money to be made there. These guys are getting wrecked, right? I wonder why. It's because of what's happened over the last 15 years. And only one of those 15 years was double digits down. Like, come on, man. Of course, people are going to say, I don't want no piece of any of the short seller funds. But, once we have a really nasty year, I'm talking like S&P down like 30+%, you just wait. All of a sudden, people are going to all be interested in these short seller funds, and they're going to start piling in money, and things will be fun for them for like the first 6 to 12 months, and then they're going to get wrecked after that.
There are closures, there are moves to long-only funds.
What happened?
So that really focused short-selling funds is really disappearing very fast.
Now, I want to clarify as well, because throwing in the towel, but not completely, even though Andrew Left said that it's a dying breed of short selling, he was also the person who bet against GameStop as it was soaring just a day ago, as he told you guys. So to what extent are people starting to step back from this industry, given that there are still obviously opportunities?
Yeah, for sure. So we have to acknowledge there are a lot of young people coming into it and very passionate about it. They're releasing a lot of reports that had really strong impact on the stocks. But that said, the amount of money you get into those funds is a lot smaller. Talking about Andrew Left, we did that story about him yesterday, but he said his bet is much smaller in size. And I think that's an interesting theme because a lot of the short sellers really struggled in 2021. And there is this kind of sense that there is still a battle with retail traders. So for Andrew Left, he got burned in 2021. He potentially incurred some more losses in May and now, but he continues to bet under those stocks. But the thing is, he has reduced the ammunition he puts in those short bets.
Is there a structural reason at this point that short selling would become more difficult for any reason?
I think on a very simple level, just the relentless 30 trillion stock market rally makes it impossible. It's just like a constant, and obviously people have been talking for so long. Now interest rates are higher, so all those more speculative bubbles and fevers in market will disappear. But that hasn't happened necessarily. Obviously, some of those big retail names saw their shares drop back to...
I think that's also scared a lot of folks away now from short selling activities and things like that is, guess what it is? The Federal Reserve. Because they feel like the Fed is so quick to act in terms of trying to save the day nowadays, right? Look at what happened in 2022, right? You have SVB go down, a couple other financial institutions, and the Fed's backstop and everything right away. If they weren't there, I think in the past they might have let that go, right? And let that be what that's going to be. And things could have got a lot uglier. But, just the way the Fed acts, the Treasury acts nowadays, they're very accommodative to asset prices, very accommodative. And so I will say it's a lot harder of a game now, I think, to play from that side, because it seems like they refuse to let the market really get hammered, right? Or at least they try their best to.
Pre-pandemic levels, but we haven't seen like a big, massive sell-off in broad market sell-off.
But what about financial watchdogs as well? Are there kind of reasons that would even scare people away from this market that are non-financial? And are there more financial reasons besides this? Are people getting stopped out, essentially? Is this becoming a losing trade?
For sure. People are like, is it really worth all the pressure? The fact that investigators may show up at your door tomorrow and say, well, you're doing something, we're investigating investigating market manipulation. Andrew Leff had a good quote about it. He said, "I honestly wish I bought tech stocks and like I didn't want my family to be worried. I would just play golf and be on vacation." So there is the regulators, there is companies suing you, there is retail traders emailing you saying you're shorting their stock. There is just like a constant pressure. There are even government bans. Like if we look at China and South Korea, there have been recent restrictions to short selling. So pretty much any side of the financial markets is kind of turned to against them, and you know they're kind of an easy victim, and it's easy to say, oh, it's their fault for a certain sell-offs.
Yeah, in terms of short sellers, you know, they've never been my favorite. I think we all know that, right? But with that being said, I have no problem with them being in the market. I think you have to have somebody there to call out valuations when valuations are out of control. I think you got to have somebody there to call out executives that are doing bad stuff, right? Somebody's got to be the cop. And so sometimes there's bad cops, right? Sometimes there's bad cops. And sometimes there's bad short sellers, right? Sometimes there's going to be short sellers that are doing illegal things and, you know, acting up and trying to be manipulative. And then sometimes there's short sellers that are just, they're actually good people, but they love to recognize when a company's being shady, when valuations are out of control, and they love to be the cop on the street. Somebody's got to do it, because if it's not them, it's no one, right? There's no one else that's going to do it. And so they're out there. And so at the end of the day, although they're not my favorite, as I've said many times, I do think they are actually necessary in the market, because without them, it would be out of control. It would be. They help keep a little bit of balance. And the short sellers will be back. They will be back. The next major downward move in the indexes, they'll be back. People will be wanting to invest in them again, and that will be that. Okay. So and in regards to some of their strategies around hedging and things like that, that can really save your portfolio in big downward moves. So if you'd like to apply to join my private group, that will be the pinned comment down there today. You can click on that, fill out an application. We'll see if we can get you in there later this week. And you can get access to the Discord chat. You can get access to all my premium courses and all that good stuff. Much love, and have a great day.